Hi everyone, this is Paul Stewart here from Segmented Solutions, another one of my technical videos for you. This time I'm going to focus on inheritance tax because there's a number of ways that a SSAS pension can reduce or eliminate inheritance tax that's just not possible with a SIPP. So whilst the SSAS and the SIPP are both pension schemes and they're both covered by the inheritance tax laws that are coming in following the budget, this will be a pensions inheritance tax planning masterclass aimed at how to use a SSAS to put some flexible planning in place. So without further ado, let's get into it. First thing is, there is a bit of a background to pensions and inheritance tax. Back in the day, when you had a fund of money that was going to be given to you for retirement, an actuary would sit with a calculator and would work out what level of pension income could be paid to you between your date of retirement and your expected date of death. They would use mortality tables and they'd work it out so that effectively there'd be nothing left on death. And that's the background. And of course, the government, or any government that is looking to raise inheritance tax, is looking at the £0 left on death bit. Pensions are designed for providing an income in retirement, is the view, and I don't want to get political. So therefore, anything that's left over and paid out is above and beyond what a pension scheme was supposed to provide. Not saying whether this is right or wrong or making any political judgments, but this is the background. This is the starting point to the current government's view that anything that's left should be subject to being added to your estate. And as we've seen in the news, adding pension money to your estate can cause all sorts of issues with regards to the tax payable on the rest of your estate. So let's have a little look at SIPPs and SSASs. SIPP is a self-invested personal pension scheme, and a SSAS is a small self-administered pension scheme. The SIPP is an individual pension, and the SSAS is an occupational pension. Now, they both can have one member. With the SIPP, it doesn't have any choices, but with a SSAS, you can have a one-member SSAS. But in most cases, with a SSAS, you have perhaps a husband and wife, or husband and partner, or two business partners, but you can also add adult family members. So with a SSAS, as an occupational pension scheme, you can have multiple people who are members who are accruing benefits. But with a SIPP, it's just an individual arrangement. Now, why is that so important when it comes to inheritance tax? Well, a SIPP, all the money that's there will be paid out on death and will be subject to the inheritance tax rules. But with a SSAS, it's got a trick up its sleeve because as it's an occupational pension scheme, it can in fact have a general fund. And that's money that's not been allocated yet to any individual. And that general fund, because it doesn't belong to anybody, isn't actually paid out on death, and also therefore means it's not going to be subject to inheritance tax. Whereas a SIPP, there is no general fund, there's no different people involved, it's just the one individual. So that's the fundamental structural difference between the two, and it makes a big difference in terms of some of the planning options available. So let's have a look at members and the general fund. If a client were to pass away, and they happen to be a member and they happen to have their portion of SSAS funds allocated to them, then there would be inheritance tax payable if that money were to be paid out. The remaining members of the SSAS who haven't died, their funds will stay allocated to them and stay sat within the SSAS pension scheme, and there'll be no inheritance tax. Same thing with the general fund. Because it doesn't belong to anyone, nobody's death will trigger a tax charge, and the money remains invested in a tax-exempt pension, which is ideal for long-term holding. For example, farmland, dare I say it, if that was sat in the general fund, there'd be no 10-yearly trust inheritance tax charges, there'd be no inheritance tax on death because that general fund physically won't belong to anyone. So assets like land and commercial property can sit neatly within the general fund, and as long as the SSAS keeps running, there'll be no inheritance tax because it doesn't matter who dies, it doesn't matter who is added as a member, it will sit within that general fund. So let's have a look how to get money into the general fund. First of all, if you have a SSAS, everything is allocated to members according to their allowable contribution limit. So that's an art form into itself to work out what the maximum member allocation is. But you can, of course, allocate contributions to the general fund to then be allocated to the member at some point in the future. So if you've got money or land or a commercial building and you want to contribute that, you can contribute that to the member. It'll be allocated to them. And if it's done in a way that's paid out to their family on death, then obviously there'll be inheritance tax. However, you can make contributions from your occupational company into the SSAS and pay it directly into the general fund. And that general fund is a great thing. It pays no UK tax on growth, on sales, on any income that is derived. There's no taxes at all. And it can sit merrily there for generations whilst other contributions are allocated to members. It might be that rent accrues in the general fund and that gets allocated to members to allow them to purchase a pension when they get to retirement. But so looking at a general fund and contributions, and it's down to planning ahead to work out where you want certain things to go. Another thing that you can do is compare retirement. You've got a scheme pension and you've got flexible retirement. And again, if you have a SSAS, whilst everything is flexible, there's nothing wrong with getting an actuary involved to do some calculations, just like pensions started in the good old days, where you work out what level of pension income could be paid throughout that person's retirement, such that in theory, there'll be nothing left on death. Going back to the old school, almost like a defined benefit pension scheme. And the calculation is done and the income is drawn and income tax is paid on that drawing. However, in the event of that scheme member dying, everything that's left, the residual fund, isn't paid out on death and doesn't impact inheritance tax. It all goes into the general unallocated fund. So there are opportunities to plan to buy a scheme pension with your pot of money in your SSAS so that you draw an income for your pension and you live on that quite happily. But in the event of your death, any residual money gets put back into the general fund without any inheritance tax. This, for example, is a great way of doing things if you have a property that's generating rent. You can look at the rent and say, right, I'll take that as my scheme pension, subject to the right calculations. You'll pay tax on that individually. If you're resident in the UK, I hasten to add, it might be that you're not resident for income tax purposes, so you don't pay income tax. But in the event of your death, the residual value of that commercial property will pop itself back into the general fund and there'll be no inheritance tax, which means no need to sell the property. Even better if you're talking about land as well, particularly farmland. There is another opportunity for planning, and that's by purchasing an annuity. Now, back in the day when you purchased an annuity with Aviva or Legal & General, the annuity money was spent, it's gone, not part of your estate for inheritance tax, but in the event of death, it would stop and there'd be no money left. But there are some self-invested annuities in the marketplace where, in the event of your death, up to £1 million can be paid out free from inheritance tax. Now, I'm going to add a caveat here. That £1 million is an allowance, and the allowance may be eaten up by the fact that you have other business assets, and it's a business asset value of £1 million that is allowed to be paid out free from inheritance tax. So if you have a business worth £5 million, then that part can't be paid out tax-free. But the rest will only be suffering tax at 20%. So you can buy a self-invested annuity that will either eliminate all of the inheritance tax or it'll reduce the inheritance tax by half. Now, with all these solutions, you actually have to sit down at retirement and work out how much money do I actually physically want to leave to my family? Because if they were to inherit, in inverted commas, £500,000, they wouldn't spend it all in one day. They might not need all of that money. It would become part of their estate. Anything they invested would generate income on which income tax would be payable. And actually, it might be better to reduce the amount that needs to be paid out to them. So you can mix and match all these solutions. The first, simplest one is just to carry on drawing down your retirement income. And in the event of death, you pay 40% inheritance tax on the money. There may also be additional income tax for the beneficiaries, and it may also mess up your residence nil band, and there's horrendous rates of tax applicable in this position, but based on your circumstances, if you wish to leave any amount of money to your family, then you can work out the numbers and you can work out how appropriate it is for your SSAS pension to be drawn down. You could, of course, use some of your money to buy an annuity, and like I said before, up to £1 million can be payable at 0% inheritance tax if you have no other business assets. Obviously, it's 20% thereafter. You could, of course, have a general fund, in which case you don't have the ability to draw down any money. All of the money sits in the general fund. You can't take any income. You can't live on that in retirement. But on the plus side, that fund is not paid out and there'll be no inheritance tax. This being the sweet spot for things that you want to keep in a pension over the generations, like, for example, farmland or commercial buildings. Or you can buy yourself a scheme pension where you draw an income, you live on that income, but on death, the rest of the fund is not paid out and therefore there's no inheritance tax. So you can imagine taking your £2.5–3 million pension fund and drawing down some of it, buying an annuity with some of it, and buying a scheme pension with some of it. The planning needs to be worked out based on your family's needs, your circumstances, and also to some extent the assets that are held within the pension scheme. It's all well and good saying you're going to go for drawdown and you're taking the rent on a piece of farmland. The inheritance tax bill comes along and you can't really very easily finance the farmland, so you might have to split it and sell it. So it's down to what your circumstances are, and that's where you need a skilled SSAS practitioner or a skilled SSAS administrator to sit and sketch out and go through all the options with you. And talking of which, we deal with SSASs, and Segmented Solutions has been around for a while setting up pension schemes and talking to clients about their various options. So if you do have a SIPP and you want to move it across into a SSAS, please don't hesitate to get in touch. And if you have a SSAS with us, I want you to rest assured that we are dealing with the inheritance tax issues, and there are a number of different options available when you come to retire. So, my name is Paul Stewart. The business is Segmented Solutions. My email address is there. The direct dial landline number is there. And I have a digital business card where all of the videos like this are updated in real time. So if you install that on your phone, as and when new videos come out, they'll automatically be included. And if you want to establish a SSAS, go to segmentedsolutions.co.uk/SSAS, and all of the documents are there. And there's also a video talking you through the administration steps, what to type, what to email, what to scan, and how the whole process works. So that's a quick run through of inheritance tax planning for SSASs. Some of the things you can't do with a SIPP. Obviously, with a SIPP, you can purchase that annuity. That's pretty much one of your only options other than taking the hit. But I know this is a political hot potato, and I'm not going to make any comments at all on the imposition, whether it's good, bad, or indifferent. All I know is that we're sat on a number of solutions, and we would be, of course, more than happy to talk with you, either to move your SIPP across into a SSAS, or to take over an existing SSAS, or to assist your business with planning for its corporation tax situation. Thank you very much for listening. My name is Paul Stewart. Take care. Goodbye.